The third quarter earnings season has kicked into gear, and as always, the big banks and financials led the reporting. Investors are assessing those reports and others. Research Director Shiraz Mian says it was a positive kickoff, and he's here now to fill us in. But Shiraz, even before the banks started reporting, two big home builders, Lennar and KB Home, missed estimates, and others are also expected to report declines for Q3. Is the housing sector going to be a negative standout this earnings season?
Yes, housing has been problematic, Terry. You would recall that as the Fed, they have started easing now, but for the past 2 years, we have been in a very tight monetary policy regime. In fact, the housing sector, along with the industrials manufacturing space, are one of the two areas that have really been affected. Automobiles is another one. So higher interest rates has been a big headwind for the space. Earnings declines, modest, but still earnings declines expected in Q3. For the year as a whole, construction is essentially flat. If you go back, Terry, 2022 was the year when construction earnings peaked, and we have been on a downslope ever since. And the hope is that 2025, after the Fed's easing cycle has really seeped into the economy and helped bring mortgage rates lower, will we see some earnings power restored to the home builders?
Looks like the banks have passed their test this time around to open up the reporting period. We're talking here on the 17th of October. Investor focused remains on the financials early this week. How does that sector look to you overall?
Yeah, pretty good. Not a whole lot was expected of them, as we have been writing about and discussing all along the last couple of years. It has been a tough going for the space. Margins have been under pressure because of the elevated interest rates, again, as we noted earlier, tighter Fed policy. And then demand for credit has been very lackluster for some time now. And related to the tight monetary policy has been the weak activity levels on the advisory and the capital market side. So all in all, a tough environment from an earnings standpoint from banks, but they have surprised to the upside. Results have been good. The market liked the results from the banks and brokers, and on the whole, they are telling a positive and reassuring story about the sector as well as the broader economy.
But the last time I checked, some were looking for the banks to report a year-over-year earnings decline. You're not seeing that?
So it's still decline, but it's a smaller decline than was earlier expected. In fact, net for the finance sector as a whole, we will have positive earnings, but for the banks, we will have a modest year-over-year decline for all the reasons that I noted earlier. But it's a smaller decline than what the consensus expectation was before the start of this earnings season.
Okay, what about the regional banks? Any growth going on there?
So the same issues, Terry. Regionals, what they lack relative to the big players, the J.P. Morgans and the Bank of Americas of the world, is the investment banking and the money management business. The core conventional banking, the lending and deposits, is the primary business for that, and that business has been under pressure for a while, but even with the regionals, profitability has been better. They are looking up in their earnings outlook, and and the market is liking what it's hearing from them. So, on the whole, the read through from the financials, including the regionals, has been the growth has moderated, but they see a stable economic backdrop with consumers still spending, though they see some issues at the bottom end of the income distribution, and they don't really see any worry areas in terms of credit quality for which they should book unusually large reserves. So they expect their assets, which are basically loans on their balance sheet, to remain pretty healthy, even though our delinquencies have been increasing. So all in all, the regionals are painting a positive and reassuring picture as well.
What does the big picture look like as far as the scorecard is concerned?
So, including all the results that came through this morning, Terry, we now have Q3 results from 64 S&P 500 companies. That's a hair under 13% of the index's total membership. Earnings are up 5.6%. Revenues are up 4.7%. 79.7% are beating EPS estimates, and 70.3% are beating revenue estimates. And on the whole, when we put these results in a historical context, this is a better showing relative to what was expected, but also a better showing for these 64 companies relative to other recent periods. So companies have been able to relatively easily beat estimates, and the market is liking that.
As companies from other sectors continue to report, are you expecting many positive surprises?
It appears to be. So I think the financials have given us a very positive start to the earnings season in a fairly reassuring read on the economy as well. And as goes the economy, so goes earnings. And I would expect that most of the other industries and sectors should come out with the trend that was set by the financials. So I've been very encouraged by the results we have seen thus far.
Okay, later today, again, October 17th is when we're talking here. After the closing bell, Netflix reports. A lot of eyes are going to be on that report. You see any surprises coming there?
So Netflix is more of a unique animal, as you know, Terry. The streaming industry has been in the news these last few years. Pretty much most of the media companies now have streaming arms. Netflix is a leader in that. A lot will be happening in the Netflix report in terms of the new subscriber additions. As you know, in recent quarters, they came out with the what they refer to as the password sharing. They have clamped down on that, and that has been resulting in forcing people to subscribe afresh. I would expect that to continue, add to their this new subscriber additions. They now have a lower price tier, which has ads in them. So I suspect that they are far more confident in having that restrictive regime in place. There may be conversation on the earnings call. I would expect analysts asking them about the subscription price. Most of their competitors have raised prices recently. They haven't. So I don't envision them coming out with a price increase this time, but there may be conversation around that. And all in all, Netflix has emerged as a leader of the streaming space, and they have found a way to be profitable in the space. And I would expect this earnings report to reconfirm that status.
What important themes then overall are you going to be watching for during this Q3 reporting period?
So reconfirmation of this, what I was referring to as a reassuring take on the broader economy. One of the big questions coming into this earnings season, Terry, was about the health of the economy. As you know, the Fed started easing rates last month, and there are some in the marketplace that feel that perhaps they were too slow in starting the process, and perhaps the process of slowdown and moderation in the growth momentum will get out of their hand. And even if they cut rates continuously, the economy may still go into a recession or an extreme slowdown. And the results from the financials ran counter to that narrative. And the biggest theme that I expect coming out of this earnings season will be a reconfirmation of what we heard from the financials, that the consumers are in good shape, that businesses are still spending, and yes, economic growth has slowed, but it's still positive, and most companies expect their growth to remain positive. So more of this soft landing narrative that many in the market has been hoping for has kind of become the consensus view, and I would expect the Q3 earnings season to confirm that.
So management outlooks once again going to be critical this earnings season, especially compared to the current expectations for Q4?
That's right. Absolutely. Management outlook has always been key, and it's even more critical in this environment where there are questions about the economy's growth momentum. So what companies see in terms of the demand for their products and services, the financial health of their customer base, and what they see broadly in the economy. So explicit guidance will be key, and even for those companies that don't provide explicit guidance, everyone will be asking them as to how they see, if nothing else, at least qualitatively, to share with us trends in their own underlying businesses and industries.
Okay, want to remind all of our listeners that they can read your written commentaries on earnings trends in between these earnings seasons as well as during them. And all they need to do to get access to the written copy is go right to the homepage of Zacks.com. Shiraz updates his earnings commentaries twice a week, once on Mondays and once on Thursdays. With Shiraz Mian, I'm Terry Ruffalo. See how you can get a free book, Finding Number One Stocks. It's a 300-page hardcover where Zacks Executive Vice President Kevin Matras reveals almost every stock-picking secret he's learned from the system that since 1988 has more than doubled the average yearly gain of the S&P 500. Learn more at Zacks.com/promo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.